And next up, we have with us Stuart Fieldhouse of the Armchair Trader. It's a daily news site serving over 500,000 investors globally. In terms of Stuart's experience, he began his career in journalism in Hong Kong and was with Financial Times for 6 years, covering wealth management and offshore funds. He has edited one of Europe's leading hedge fund trade periodicals and worked for $15 billion hedge fund of hedge funds, as well as having written a couple of books on FX trading and spread betting for beginners. The crypto space is constantly evolving, and joining Stuart will be David Brickell, a director of institutional sales at Bequant, a digital assets prime brokerage and exchange. David started his career as an economist, working for the government economic service before moving across to the private sector with 18 years of experience under his belt in macro trading and sales roles at top-tier investment banks. He moved to Bequant in 2021, helping to build the business and facilitate the institutional adoption of digital assets. So take it away, Stuart and David. We've got lots to unpack. I'm really excited. The floor is yours.
Great. I'm Stuart Fieldhouse, editor of Armchair Trader, as has already been explained. But we cover a lot of different markets in the course of an average week, and we do have house views which we develop across our team of over 10 journalists and analysts. And really, I think for us, looking at the coming year, we anticipated last year that there was going to be a bit of a squeeze in the gas market, and I think commodities is going to be a big theme for us and for the markets really going forward into the year. The reason we see this is because with commodities markets, we always look for dislocations. So we saw dislocations during the pandemic in the oil market. We've seen it again in gas. I think we'll see more of a squeeze in gas futures going forward this year, particularly when you've got pressure being exercised on the gas market by Russia. But in addition to that, we've seen some very interesting trades that have developed in more niche commodity markets as well. And a lot of this has been down to really pandemic forced dislocations. And we've seen some really quite interesting trading opportunities appearing in the future space. A good example, which we covered recently on the site, was cotton futures. That's not a market many people are familiar with, but that has been a very interesting soft trade for a lot of professional traders, and it's one that we highlighted as well for our readers. So we anticipate really in the first half of this year that we'll see some more very interesting commodity plays emerging. The one that I think a lot of people were expecting we would see more action in and has disappointed a lot of people, and it's been a story with our readers and with ourselves all the way through last year, was the gold trade. There was always an expectation that we would see more upside action from gold, and a lot of traders I've spoken to last year have been scratching their heads on this one. There have been a lot of crazy conspiracy theories about why this didn't happen, but one that we've heard a lot about was cryptocurrencies, and the fact that the sort of traders who would have been trading gold have instead been using Bitcoin as an inflation hedge or as a store of value. Now that trade has come a little bit unstuck over the last few weeks. But luckily today we've got David along too, so he's got a lot more in-depth expertise on Bitcoin or the cryptocurrency markets than I have. So I thought we'd give David an opportunity to give us his perspective on gold and on Bitcoin as well.
Sure, thanks, Stuart. Yeah, I guess what's quite interesting from my perspective is it was the macro story that drove me into crypto in the first place. So I've been involved as an investor now for 6 years or so, and finally moved over to Bequant last year and took my career in that direction to help facilitate the institutional adoption of digital assets. So to your point, is there a substitution between gold and Bitcoin? I think there's a couple of things that interest me in this discussion, and some clarification. So firstly, for me, gold is an inflation hedge, as is Bitcoin, but gold is the low beta inflation hedge. Plus, it's a safe haven and trades with a risk premium. Bitcoin, on the other hand, is a high beta inflation hedge, and something we can talk about, what I consider more of a currency debasement hedge. So I think what you find is both are doing their job in terms of hedging inflation, in so much as how the market measures inflation. So if you actually look at 10-year break-evens, now markets look at inflation over a period of time, and price assets according to that. And if you look over a period if you look at 10-year break-evens, we've actually tracked both in gold and Bitcoin pretty much the path of break-evens, if we talk about since 2020. And actually what you'll see is we obviously had a big dip in break-evens and measures of inflation in March 2020. And then with all the stimulus, ever since then, we've been on a path higher, of which obviously Bitcoin has followed, and gold to a lesser degree. Now, Bitcoin is the high beta, so you're going to get massive outperformance. So in these reflationary environments where central bank policy is easy and reflating assets, then I think there's a high beta substitution effect towards Bitcoin. So Bitcoin's massively outperformed, and gold has struggled. The other side as well, that's perhaps been a headwind to gold, is that risk premium that I mentioned. So as risk is trading well, the safe haven that would have sort of benefited gold as the crisis hit, that premium starts to come out of gold. And if you actually look at 10-year break-evens last year, they kind of peaked. They kind of peaked in about May, June of last year, when Bitcoin peaked, and then we had a big sell-off. And then it kind of drifted sideways, and then again sort of ramped up from about September, and peaked again in November. And both gold and Bitcoin, once inflation expectations for the break-even started to go up, both gold and Bitcoin both traded higher. They peaked about mid-November, in the 10-year break-evens, and have come off. Obviously, Bitcoin has now struggled with that, whereas gold, what it's maybe losing on the inflation side, has now gained in terms of the safe haven, given the risk-off environment that we're in at the moment.
And we've obviously had some big news out from the Fed, as already been mentioned this evening while we've all been online. It's that again, that's another big theme we've been looking at. Armchair Trader, we published a study end of the year. Actually, our hand was a little bit forced because we put together a list of our 5 big market risks for 2022. And we were working on it, and one of them was a mutation in the COVID virus, and then Omicron actually broke while we were writing that report, so we had to go early with it. But another one was inflation, and was the whole rising interest rate story. That looks to us like it's going to be a really dominant theme. It's not just about this evening. I think we're going to be seeing this over. And this is quite a new theme for a lot of traders who've been used to, I mean, certainly in my career, and it's been a very long period of virtually zero interest rates, and then all of a sudden we're starting to see the central banks raise rates, and everyone's getting really excited. What's your view on that, David? I mean, is that would you concur with that? Do you think we're in for a roller coaster ride there?
I think short term we're in for a roller coaster, certainly into March. But I've actually got a more sanguine view if I look ahead of that. And my reason being, so there's a couple of points that I'll make as a background to how I've arrived at this view. And firstly, in fiat credit-driven worlds, which we're in, credit drives economic cycles, not the other way around. So if we look at the response to the pandemic in 2020, we saw this massive explosion of credit, which central banks and governments sort of pushed into the market. And if you look at the credit impulse in G5 economies, we had this massive explosion in credit that was off the charts into about mid-June 2020. Now that credit tends to lag the real economy and economic cycles by about 12 months, give or take. So past mid-June 2020, we then started to see that obviously, and as a rate of change in terms of the credit impulse start to fall. And by mid-2021, it fell deeply into negative territory, and it's still there now. So I kind of think the growth we've seen over the past year was largely a function of the credit explosion mid-2020 that sort of drove growth into 2021. Now we're starting to see, as credit slowed down, and indeed as the impulses turn negative, we're starting to see a year on of that subsequent slowdown in growth. So my view is that we'll see growth start to slow down quite substantially, cyclically. And I think we're starting to see that. Now, some are thinking that post-Omicron, end of pandemic, we're going to get this bounce. But again, I think this is cyclically driven, and I don't think we'll see that sort of big bounce. Because I actually think during lockdown, we just kind of in many ways saw a substitution from services spending to goods spending. And we essentially we put a lot of money in people's pockets through the fiscal that then went out and spent it on goods because they couldn't go and spend it in restaurants and bars and entertainment. So in terms of where we are now, and you've already seen that the savings rate, which spiked, actually come sharply lower. And the latest credit card data has seen a real big ramp up in the US in credit card spending, which kind of tells me that actually savings rates aren't as high as we thought. And the US consumer particularly is possibly tapped out and needing to build credit up again. On the inflation side, as we said, we had the fiscal impact, that sort of fiscal splurge, creating this artificial one-off demand at the same time that we had supply chains disruption that couldn't meet that demand. Now, for me, you got both this cyclical slowdown that's coming, so demand's going to fall, at the same time that you've got supply coming back on demand in a post-pandemic world. And quite quickly, I think you're going to see those trends we've seen in inflation reverse. I don't think there's been a structural change to inflation. And in fact, I think we're still in a structurally disinflationary environment, with those drivers being demographics, but mainly debt and technology. And debt levels are higher than they've ever been. And technology, I think the move post the pandemic has forced more companies to embrace technology. So the headwinds are blowing stronger at the same time that supply is coming online, inventory levels are higher, and demand's falling. So coming back to that, I think we've priced a lot for a Fed. The Fed are clearly concerned about where spot inflation is and perhaps some political pressure. So they've talked up rate hikes. We've priced a lot in, I think, 4 hikes and maybe more for this year, as well as fears around QT. My actual view is that the data won't allow them to do that. I think clearly we go NQE come March, and possibly they get 1, maybe 2 rate hikes off. But I think we're going to see, particularly into half 2 of this year, a substantial, not just slowing, but also inflation coming off, and even potentially some negative prints on the base effects in towards year end. So I kind of think we're going to have, the Fed aren't going to be anywhere near as aggressive as they would like to be or talking about, because I don't think the data is going to allow it.
Do you think it's just we're in a slightly unusual environment though? I was talking to a fund manager yesterday, and he raised this point of yes, the central banks are going to be raising rates, but at the same time, there's still a lot of stimulus in the market. I mean, at the end of the day, that's presumably going to create some kind of an equilibrium until they start to really dial back on the stimulus.
Yeah, I mean that's why. I mean, right now the market is trading with this fear. Market's called up on the fact that growth is slowing down, just as the Fed have turned hawkish, and it feels very December 2018, where we were starting to price a hawkish Fed into a slowdown. You're seeing curves flatten, and it won't be long if that flattening continues, where we start hearing people talk about recession. But And it's often with markets about the direction of travel, and that's what everyone's worried about, is the direction of travel is towards that. But right here, right now, there's still a lot of liquidity. The Fed is still really easy, and for all their tough talk on inflation, you know, their decision tonight, they're still doing QE, they're still printing money, so they're still pumping more liquidity into the market. So I kind of feel when once we kind of see that. And perhaps hear more from the Fed that, look, they're going to be a little bit more balanced, a bit more nuanced than just inflation's higher, we're going to hike regardless. Then actually I think risk will trade quite well, and we'll see a recovery, because as you say, there's still a lot of liquidity, and money is and interest rates are still super low, and real rates are still very negative. So I still think it's if I look at that alone, it's probably a reasonable environment still for risk. It's just the uncertainty in terms of as we transition from one regime to the next, from this easy policy to potentially tighter policy, and then the fear about how tight that gets. That's what panics markets, and I think that's what we're seeing right now.
Yeah, and then of course we've got the midterm elections coming up right at the back end of the year, which could create some more turbulence as well. I know we've only got 15 minutes for this slot, so I just wanted to, we were talking a bit about the long duration trade before we came on this call. Can you give us a bit of background on that as well before we finish?
Yeah, so I guess in line with what I was saying, probably my most controversial view, and I don't think it should be, but is that QE drives rates higher, and tapering and tightening actually brings rates lower. And why that is QE, for me, it forces people out across the risk curve, and also it increases expectations for growth and inflation. So yields go higher relative to where they would have been. When we're tapering or tightening, we go the other way. People come back in across the risk curve, back towards the safety of bonds, and also reduce their view on growth. So as you start to see that repricing of growth, I think what you're seeing is you'll see yields top out and start to move lower, and duration perform, which actually then makes me think growth stocks will perform as well. And then crypto, I think, will perform as that high beta sort of growth move as well.
And crypto is, I mean, obviously, you know, has been a massive area of focus, and we've been talking earlier this evening about the number of new traders who've come into the market, and the fact remains a lot of those new traders are in the cryptocurrency markets. It has, I mean, Bitcoin has sold off quite a lot, but even today I'm seeing a lot more enthusiasm around cryptocurrencies like Ethereum, for example. Cardano has been attracting a lot of interest. Do you think that the cryptocurrency is here to stay, and that in like a couple of years' time we'll be just talking about it like we do mainstream Forex markets, and a lot of traders will be in it?
Yeah, well, like working at Bequant, you know, we don't even have that conversation, because we're seeing it every day, and we're seeing institutional clients, traditional institutional clients, moving into this space very, very, very quickly. So the technology and everything that's sort of building around it, it's definitely here to stay. It's now just a case of how it gets regulated. It needs regulation. We want to encourage the regulation, because that will bring all the institutions in, and it will make it more accessible for everyone. So it's definitely here to stay. The technology is definitely here to stay. And I also think one of my big, from a macro point of view, is that I think central banks are caught in this liquidity trap at the zero lower bound, and they're going to increasingly need to go towards QE as a standard policy tool. And what that essentially does is, when I say about currency debasement, it's artificially inflating assets. So the value of fiat currency relative to assets continues to fall, and that's great if you own the assets, but it's not so great if you don't. And that's going to continue to drive this inequality divide. And historically, when any system's put under pressure, now the Fed or central banks aren't going to let the system go. So whenever any system essentially kind of reaches its endpoint and needs to change, then a new system emerges. And for me, that new system is crypto.
Great, thanks very much indeed for that, David. We can take some questions if there are any from the floor on what we've just been discussing, or more generally.
Yeah, there are some questions. And thank you, Stuart and David. That was really informative and unique, especially where you're talking about how QE actually leads to high yields. And that was a really interesting explanation of the mechanics behind that. So we've got a question here from Ben, who asks, if traditional markets fall, what would be the expected effect on digital assets? Is there a relationship between the two?
Yeah, well, as I say, I think digital assets, short term at least, and particularly as any kind of adoption technology, any exponential trend, tends to be very high beta. So I think as risk gets hit broadly, then you see an even outsized sort of turn lower in the digital asset space, just from a pure kind of like beta correlation. However, there is also a massive idiosyncratic story underpinning the whole crypto space, and particularly the different projects and tokens and coins within that space. So it's not a one size fits all. I certainly think the Bitcoin and that, which is more of a macro story, and certainly the sort of larger cap coins that the traditional investors are now playing in, where when you get a VAR shock and risk assets sell off, they de-risk everything, and crypto gets caught up in that. And it will be the coins that they're holding, the Bitcoin, Ethereum, and the top market cap coins. But there's also some idiosyncratic stories that are emerging as well that will trade better. So you'll see some relative value trades within it. But short term, yes, we're going to be highly correlated with risk. I think the long term story will over sort of ride that long term, as well as I think the macro headwinds will continue to support it as well.
Great, thanks, Dave. That was a good answer. And then just lastly, you spoke about this competition between gold and Bitcoin. And, obviously, as millennials become a more important demographic in the investable universe, they have a preference for what cryptos dubbed digital gold over traditional gold. But I think, in my opinion, and you can shed some light here, I think what's one of the impediments is given the volatility from a portfolio risk management perspective. So how long do you think that timeline is before we see that proper market share eaten into from gold by Bitcoin?
Yeah, I think for the volatility to really die down, you're probably looking at a 5-year plus period. So as the technology grows, as the adoption grows, it's going to be a volatile path, and then I think you'll see it settle down and become less volatile. And also, once it's got the history, I mean, the advantage that gold's got over Bitcoin is history. It's been around for centuries, performing the role that it has been. Bitcoin for me is just, in the ultimate end of world scenario, in this modern day, Bitcoin actually fulfills, that sort of safe haven need much greater than what gold does. Certainly from the fact that it's really difficult to, if you need to move country, to shift gold. So I think over time, once the history builds, once the institutional adoption builds, then at least Bitcoin will certainly, the volatility will stabilize, and I think you'll see less volatility and more money will come out of gold into Bitcoin, and then I think it will perform within the ecosystem a very similar role to gold, where it'll actually become more of a low beta asset, and actually the higher beta stuff will be some of the other coins and tokens within the crypto space.
That's very interesting, David, and I think we're going to see some interesting developments in terms of Bitcoin's evolution and the whole crypto space in general. Thank you so much for joining us both. It was I found it very exciting and some unique perspectives there. Look forward to seeing you again soon.
Thanks very much.
Perfect. Going on to our next presenters, Corellia.